Hello. There is an impact of risk aversion in the overall market on the required return on individual stocks. Okay. So now what we're looking at is we're going to be looking at this using that security market line, that SML line that we have here. And just as a recap, is that we have this is based off our CAPM equation, is that we have our risk-free rate, which is that bottom level, which is this horizontal line that is going across here. Okay, and then we have the risk premium that is then multiplied by beta. Okay, and so we have a high beta stock has a higher required return than a low beta stock does. Okay, so what we're looking at here is that we have a high beta stock, which is going to have a beta of 2 multiplied by a risk premium of 5%. Right, our 5% risk premium is given up here. We have a 3% risk-free rate, and then we multiply, remember, beta by that risk premium. Okay, so we multiply a high beta 2 by the risk premium of 5%, so that gives us 10% on the risk adjustment on a high-risk stock. Okay, and that is going to be added on the top of a stock which would give it a 13% on that high risk, right? The 10% plus the 3%. On an average stock, right, it's going to have a beta of 1, and that's going to be a beta of 1 multiplied by the risk premium of 5%. So we have a risk adjustment there of 5% plus the risk-free rate, which is 3%, which tells us the total return required on that one is going to be 8%, okay? And then on a low beta stock of 0.5, we have a 2.5% risk adjustment, which is added on top of a 3% risk-free rate, which is at 5.5%. Now, what happens if we enter a scenario such as 2008, 2009, right, when nobody really wanted to own stocks? This was the most recent large adjustment in the overall stock market, okay? So during that time period, there's a lot of things going on. People didn't have a lot of high expectations about companies being able to generate profits for a long period of time. So with that being said, is that the overall investor became more risk averse. Okay, so what that means is that in order for them to own shares of stock in various companies, is that their compensation then needed to rise, right? We had a risk premium that was rising. This is the overall market risk premium, okay? Now what happens here is that we're able to make an adjustment here to our security market line, okay, which is going to shift up, okay? And when I say shift, it's not exactly a shift, it's more of a rotation because we see that the horizontal axis remains constant, okay? Because that is saying that we have a beta of 0. If we have 0 multiplied by the risk premium, it doesn't matter what it is, it's going through the intercept, which is at that risk-free rate, okay? So then when we follow this, okay, is that we have the risk premium, the adjustment here, is, let's say the risk premium goes up to 6%. Okay, it was at 5%, now it's at 6%. We have a 0.5 beta. 0.5 multiplied by that 6% means we're going to have a 3% risk adjustment now, right? So the required return went from 5.5% and now it is at 6%. Okay? Same thing happens at a beta of 1. Okay, the adjustment here, right, that's going to be a 6% increase in that risk-free rate, okay? And then when we look over here at the high beta stock, right, we are showing here is that we have at 12%, okay? So we have an adjustment here, and we see that the difference, okay, the difference now here is at 2%. The difference at the beta of 1 is at 1%, and the beta at 0.5 is at 0.5%, okay? So we have here, it is a rotation. It goes to the same intercept, but it now has a steeper slope, right? And so we are still able to track this out and look at where this stock is going to be on that. And so we have this change in that risk premium if the market is overall more risk averse. Now, after the economy can recover a little bit and we enter into a boom time, more like we've had in recent years, is that the security market line will shift down, right? It will shift, it will come down a little bit, and then that means that we will have a lower risk premium, okay? So The point here is that we're showing we have more risk aversion. That means that the risk premium is going to go up. Okay? Now, the second question that we need to look at here is what happens to the overall stock prices, the overall stock market, when there is a recession, when there is more risk aversion. In 2008, 2009, we were now more risk averse, which means that that risk premium was rising. Okay, so we had a rising risk premium based off of that CAPM, right? So we have our risk-free rate plus beta multiplied by the risk premium. And what happens here is that the beta is remaining constant, risk-free rate is remaining constant. We have an increase only an increase in the risk premium. If we have an increase in the risk premium, that means that the return on individual stocks, every single stock in the market is going to increase. When the return on those stocks is increasing, what is going to happen to the valuation of a company? Okay, so we're going to put this into the model of the Gordon growth model, the constant growth model, right, which is the price today is equal to D1 divided by R minus G, the dividend tomorrow divided by the required return minus the growth rate, okay? The dividend is expected to remain constant, the growth rate is expected to remain constant, but now that we have that risk-free rate rising, right, we have the denominator of an equation going up, the entire equation, P0, means that it has to be falling, right? When a number of the denominators going up, the entire number has to be falling. So prices are falling, okay? So that's kind of what we're seeing here. The risk premium rises, leads to the required return rising, which is leading to the prices. Every price in the stock market is going to be falling, okay? And that's what we saw in 2008, 2009, is we saw that when the risk premium was rising, okay, it was shifting that security market line up, and it was changing every single stock across the market, the required return on those stocks, because investors just needed to make sure that they were compensated enough for owning that stock, okay? And then we see this running through that Gordon growth model and every other valuation model we look at, that the price itself is going to have to drop, okay? And that's what we saw in 2008, 2009. Right? However, then we come into boom times, right? We enter into a boom time. We are now booming, okay, is that the risk premium is going to fall. What do you think is going to happen when the risk premium is falling? What happens to the required returns? Well, the required returns on those stocks are going to fall. If I have high expectations this company is going to do great things, I don't have to get compensated as much because there's not as much risk. Okay, so the required return is falling. And then what happens to the stock prices when that happens? Stock prices end up rising. This is what we saw in the late 1990s. Okay, companies were deemed to be can't miss. They're just going to be crushing it. And so the stock prices, the stock market was absolutely booming. Okay. So that was a basic description of what happens to stock prices and the required return on stocks when there's a change in overall market sentiments. Okay, remember that this is not talking about an individual stock. This is talking about the overall risk premium on the stocks in general.